All right, let's dive in. We're going back in time a bit today.
Back in time.
Well, sort of. We're taking a look at the FinShots recap from December 27th, 2024.
Ah, okay. Like a little year-end review.
Yeah, exactly. They always pull together these really interesting economic stories.
And what are we focusing on today?
Well, I thought we could dig into some of the things that maybe flew under the radar.
Under the radar. You mean like the stuff that wasn't making huge headlines?
Exactly. The hidden gems.
I like it. The stuff that makes you go, I didn't know that.
Exactly. So first up, remember those three economists who won a Nobel Prize?
Oh, yeah. Basically explaining why some countries are rich and others aren't.
Right. Like, what's the secret sauce?
And their big idea was all about institutions, right? Not just geography or resources.
Exactly. Acemoglu, Johnson, and Robinson.
Yeah, they argued that strong institutions,
Strong like how?
well, things like solid property rights, reliable courts, low corruption.
Ah, so it's about creating a level playing field.
Exactly. A system where people can trust that the rules are fair.
And that encourages investment and innovation.
Exactly. And on the flip side, they looked at extractive institutions.
Extract.
Yeah, where power and wealth are concentrated in the hands of a few.
Ah, so basically, systems that are rigged to benefit the elite.
Right, and those tend to struggle economically because there's no incentive for most people to work hard or innovate.
Wow, that's fascinating. But wait, this idea applies to more than just countries, right?
Oh, absolutely. Think about a company with terrible internal practices.
Like a super toxic workplace.
Exactly. It's almost like an extractive institution on a smaller scale.
Because all the power is with the bad boss, and everyone else is just suffering.
Exactly. And that leads us perfectly into the next big theme, toxic workplaces. It's not just bad for morale.
It actually hurts the entire economy.
Yeah, big time. FinShots cited all these studies showing that toxic environments lead to lower productivity.
Oh, I can totally see that.
Plus, you've got employees burning out, quitting left and right.
Yeah, the constant churn.
And then there are the healthcare costs. All that stress takes a toll.
Wow, it's like a domino effect. One bad workplace can really mess things up.
It's crazy, right? And here's the kicker. FinShots pointed out that a lot of employers are just ignoring the problem.
Ignoring it. Why would they do that? It's costing them money.
It's complicated, but sometimes those costs are kind of hidden. They don't show up right away.
Ah, so they're kicking the can down the road.
And, really fixing those deep-rooted cultural problems takes real effort.
It's easier to just pretend it's not happening.
Yeah, unfortunately. Speaking of things that are kind of overdue, remember India's census delay that year?
Oh, yeah, that was a big deal.
Huge. They called it increasingly urgent in one of the articles.
Increasingly urgent. That sounds scary.
Imagine trying to plan, well, anything. Infrastructure, education, healthcare.
Without knowing how many people you're dealing with.
Exactly. It's like trying to budget for groceries without knowing how many mouths you need to feed.
Total chaos. So what was the holdup with the census?
It was a bunch of things, really. Logistical challenges, political stuff.
Political stuff, huh?
Yeah. And there were debates about the best way to even collect the data.
So just a whole mess of complications.
But the longer it dragged on, the more it started to feel like a ticking time bomb.
A time bomb for the Indian economy.
Exactly.
So we've got Nobel Prize-winning insights about institutions, toxic workplaces, and a census crisis. It sounds like 2024 was a wild ride.
Yeah, definitely had its moments. And we're not done yet. FinShots also covered some surprising developments in finance, particularly with those sovereign gold bonds.
Oh yeah, those are supposed to be super safe investments, right?
They are, or at least they're perceived that way.
Like the kind of thing your grandma would have tucked away somewhere.
Right. But it turns out even governments can have buyer's remorse.
Buyer's remorse. About gold bonds. That doesn't sound good.
Well, the Indian government was starting to rethink their strategy with these bonds.
And it all comes down to the price of gold, right?
Exactly, because when governments issue a lot of gold bonds, they're basically promising to pay investors back at a certain gold price in the future.
Okay, but what if gold prices go way up?
That's the risk. The government could end up on the hook for a lot more money than they anticipated.
So they're kind of betting against gold going up too much.
You could say that. It's a calculated gamble. And it raises an interesting question.
About whether gold is really the safe haven we all think it is.
Exactly. And are there better ways to protect ourselves from economic uncertainty?
Ooh, good question. Okay, this is making me rethink everything I thought I knew about investing.
It's always good to challenge those assumptions. But before we dive into that,
FinJaws had that interesting piece about the Buffett indicator too, right?
oh yeah, Warren Buffett's favorite market metric.
So is it really that easy to predict market trends?
Well, the Buffett indicator does have its limitations.
Even Warren Buffett can't perfectly time the market. Shocking.
Even the Oracle of Omaha has to contend with the complexities of the economy.
So what's the catch with the Buffett indicator?
Well, it doesn't always capture the full picture of economic health. It's a good starting point.
A starting point, but not the whole story.
Exactly. You always have to think critically, consider the context.
So even when it comes to something like the stock market, you can't just blindly follow one indicator.
Nope. You have to do your research and stay informed.
This is giving me so much to think about. We've got Nobel Prizes, toxic workplaces, India's census delay, gold bonds, and even Warren Buffett's market wisdom.
It's a lot to unpack.
And we're not even done yet. FinShots also had those quick hit stories, like the RBI giving a massive cash injection to the government.
Oh yeah, what was it? 2.1 lakh crore?
Something like that. Mind-boggling. We have to figure out what that means for the average person.
And then there was that whole frenzy over Coldplay tickets.
What does that say about how we value experiences? We'll have to unravel those mysteries in part 2 of our deep dive.
Looking forward to it.
Welcome back. We're picking up right where we left off, still digging into that FinShots recap from December 27th, 2024.
Yeah, lots more to uncover.
We were just about to tackle that story about the RBI giving a huge chunk of cash to the government.
Right, 2.1 lakh crore. A pretty hefty sum.
Yeah, like what does that even mean for the average person? Is it a good thing?
Well, on the surface, it might seem like more money for the government is always good, right?
Yeah, like maybe it means tax breaks for us.
Maybe, but remember, economics is all about trade-offs.
Trade-offs, huh? What do you mean?
Well, this kind of massive transfer from the RBI to the government could actually lead to inflation.
Inflation, oh.
Yeah, prices going up, everything getting more expensive.
Like my morning coffee suddenly costing twice as much.
Exactly. Because when the government has more money to spend, it can boost demand in the economy.
So more people are buying stuff.
Right. But if the supply of goods and services can't keep up...
then prices start to climb.
Exactly. So this bonanza could actually backfire.
That's not good. So it really depends on how the government uses the money. Right?
Absolutely. If they invest it wisely in things that boost productivity and economic growth.
Then it could help offset those inflationary pressures.
Right. It's all about strategic spending.
No pressure, government. All right, let's move on to something a bit lighter. Remember that whole frenzy over Coldplay tickets?
Oh, yeah. That was pretty wild. People are going crazy for those tickets.
What is it about Coldplay?
Well, it's more than just Coldplay. It actually reflects a larger trend in the economy.
A trend? What do you mean?
People are increasingly prioritizing experiences over material possessions.
I get it. Like, they'd rather spend money on a concert than a new gadget.
Exactly. They want to create memories, have unique experiences.
And travel to exotic destinations.
Yes. So businesses need to figure out how to cater to this experience-hungry consumer.
We're seeing more immersive entertainment, personalized travel, right?
Exactly. Even the boom in the creator economy is part of this shift.
It's like we're moving from a stuff economy to a feels economy.
That's a great way to put it. But it poses a challenge for economists.
How do you measure the value of a memory or an experience?
Right. It's not as straightforward as tracking the price of goods and services.
Makes you wonder what people will be spending their money on 10 years from now.
What kind of experiences will they be chasing? Who knows? But it's fascinating to think about.
Okay, but before we get too lost in the future, let's circle back to something we discussed earlier.
What's that?
Those Nobel Prize-winning economists and their work on institutions.
Acemoglu, Johnson, and Robinson. Yeah, their research is so relevant.
But how does it apply to our everyday lives?
Well, think about the institutions you interact with daily.
Like what?
Your workplace, your community, even the online platforms you use.
Okay, I'm listening.
They all have rules, norms, power dynamics that shape your experience.
And ultimately, my economic reality.
Exactly. For example, does your workplace encourage open communication? Value fairness?
Or does it feel more hierarchical and restrictive?
That's the key question. You can apply those principles of inclusive and extractive institutions on a smaller scale.
Wow, I never thought about it that way.
But it's all around us. Once you start seeing those dynamics...
You can start asking important questions.
Right. Like, how can you support Organizations that align with your values.
How can I advocate for more inclusive practices in my own life?
Exactly. It's about recognizing those patterns and making conscious choices.
It's like those economic theories are suddenly coming to life.
It's exciting, isn't it?
This deep dive is making me think about the world in a whole new way.
That's what we love to hear.
It's not just about understanding those headlines, it's about understanding how they impact us personally.
And how we can shape our own economic realities.
Well said, but hold on. We still haven't tackled everything from that FinShots recap.
You're right. We need to revisit the government's gold bond strategy.
And we have to unravel the mystery of the Buffett indicator.
Buckle up. We're diving even deeper in part 3 of our economic adventure.
And we're back! It's the final stretch of our economic deep dive with the FinShots recap from December 27th, 2024.
Can you believe how much we've already covered?
I know, right? Nobel Prizes, toxic workplaces, India's census drama, Coldplay.
It's been quite the journey.
But we still have a few loose ends to tie up, right?
Right. We left off on that cliffhanger about sovereign gold bonds.
Yeah, those supposedly safe investments that everyone's grandma loves.
The ones that are supposed to be inflation-proof.
But as we were saying, they can actually become a liability for the government.
Especially if gold prices start going crazy.
Because they're locked into paying back investors at a certain price no matter what. Right?
Exactly. So if gold suddenly skyrockets, those bonds could get really expensive for the government.
It's like they're crossing their fingers hoping gold stays stable or maybe even dips a little.
It's a bit of a gamble, for sure.
Yeah.
And it makes you wonder about gold itself, you know?
Is it really the safe haven we all think it is? I always thought gold was like the ultimate backup plan.
It's been seen as a hedge against inflation and uncertainty for a long time.
But are things changing?
Well, the world is definitely changing. New asset classes are emerging all the time.
And diversification is always key, right?
Absolutely. You don't want to put all your eggs in one basket, even if it's a shiny, gold-plated one.
So you're saying it's time to rethink those old investing rules.
It's always good to reevaluate, especially in a dynamic economic landscape.
And speaking of reevaluating, we were talking about the Buffett indicator earlier.
Oh yeah, Warren Buffett's famous market metric.
Comparing total market capitalization to GDP, right?
That's the one. It's a surprisingly simple tool.
But you were saying it has its limitations.
Well, it doesn't always capture every single nuance of the economy.
So even Warren Buffett can't perfectly time the market with it.
Even the Oracle of Omaha has to contend with the complexities of the real world.
So what's the takeaway then?
I think it's a good reminder that no single indicator tells the whole story.
You have to look at the bigger picture.
And be willing to adapt your strategies as new information comes in.
This is making me realize that economics is way more dynamic than I thought.
It's not just about static numbers and graphs.
It's about understanding these constantly evolving forces that shape our world.
And the choices we make every day.
Wow, this deep dive has been a real eye-opener. It's not just about understanding those headlines.
It's about understanding how they impact us personally.
And how we can make more informed decisions.
Exactly. Knowledge is power, as they say.
A huge thank you to FinShots for giving us so much to think about.
They always curate such fascinating stories.
And thank you, dear listener, for joining us on this economic adventure. Keep exploring, keep learning, and we'll catch you on the next deep dive.